Good afternoon, and welcome to the Office of Credit Union Resources and Expansion's webinar, Looking for a Cure for Share Insurance. Of course, we like to think share insurance is the cure to instill public confidence in the credit union system. Please take note of our administrative announcements. Allow pop-ups, adjust your volume, resize your view if needed, and use the Submit a Question button if you'd like to ask us a question. And please don't forget, we'll send you a survey at the end of the webinar so we can get your feedback. Our webinar today will focus on the basic fundamentals of share insurance presented by a variety of our staff from our Consumer Access Division. We'll answer your questions and provide resources that you can use. And don't forget to tune in August 15th for our second part of this webinar when we'll give you the cure in depth. And now I'd like to introduce our host for today, Sheila Snock.
Thank you, Jean Marie. It's been a pleasure. So, as Jean Marie said, we're from the Office of Credit Union Resources and Expansion, and part of our duties in that we answer questions regarding share insurance. I have a panel here of a lot of experienced folks here in share insurance, and I'll introduce them at this point in time. This is Melissa Fowler, a consumer access analyst. Leilani Stamper, and also a consumer access analyst, and also program officer Annette Moore. And you can see the slide here, we will be having, to reiterate what Jean Marie said, we are having a second part of this series of webinars on August 15th. We're giving you the cure in depth. As Jean Marie stated, we're going to do some of the basics, address some of the basics today. We will be getting into the more complicated issues in the next webinar. So to start it out, let's just talk a little bit about the history of NCUA and the NCUSIF. And to address this issue, I would like to lob that question to the lovely Leilani.
Thank you, Sheila. So Congress established the Share Insurance Fund back in 1970. Would you believe that the share insurance coverage was just $20,000 back then compared to our $250,000 limit we have today? The fund was established to protect members against any credit union failures during that time, and that is what it is for today, during this time period as well. It covers all federally insured credit unions, and at this time, we have never lost a penny on members' money.
So that's federally insured credit unions, meaning federal charters, and also federally insured state charters.
That is correct, yes.
Okay. All right. And also interesting that we found out prior to 1970, there was no share insurance. So actually all the members were on the hook, which is really kind of scary. So anyways, you know, we talked about share insurance. Annette will give us a little bit of a rundown regarding what do we insure? When does it kick in?
NCUA steps in with its share insurance coverage when a credit union fails. Basically, the credit union becomes insolvent. Their net worth is 0% or less. It does not cover fraud if you have an employee commit fraud, nor does it cover if a member has identity theft against them. So those types of losses are not covered by NCUA. Mm-hmm. There is bond coverage for employees, and there's also other insurance out there for fraudulent activity like identity theft, mm-hmm. generally provided through CUNA.
Mm-hmm. And we are not CUNA, even though we have the same initials as CUNA. We are not CUNA. A lot of times people do confuse NCUA, National Credit Union Administration, with CUNA.
One more thing, Sheila, I forgot to say, is that if a credit union offers investment type accounts, they may have like a CUSO or another entity there.
Like investment services or
investment
something?
Services, okay. Exactly.
Mm-hmm.
Those deposits or those funds at those investment type products are not going to be insured. Only the deposits at a federally insured credit union are going to be insured. And the way in which you tell that is that it appears on a member's statement. Investment products would not be on a member's statement that they get from the credit union.
Oh, okay.
Okay.
So Annette addressed when does the insurance kick in. Now, Melissa is going to talk a little bit about, the account types and share types. And can you put the next slide, please, Patty?
So when you are looking at share accounts in a credit union, some of the types of products that a credit union may offer might be called savings or regular shares, checking or a share draft account legally, money markets, some club accounts, term certificates, and IRAs. And those are terms that are commonly used in the credit unions. But when we look at it for insurance purposes, we look at it slightly differently, and we look at it in terms of ownership types. And if we move to the next slide, we'll see there that there are different types of ownership structure. There we go. So there are individual or single owner accounts, joint or multiple owner accounts, and the key to both of those is they do not have named beneficiaries. Once you start naming beneficiaries, it becomes a type of revocable trust. There are different ways to create revocable trusts, but those accounts have beneficiaries. There's also irrevocable trusts, retirement accounts, usually those are traditional or Roth IRAs, and then a credit union can offer business accounts. Each of those product types are separately insured. So an individual account is separately insured from a joint account and so forth. So that's what we look at as key to determining insurance coverage.
Well, thanks a lot, Melissa. So I'm wondering, with all these different types of accounts or account types, I wonder if there's a way that we can, strategically maximize our share insurance coverage. And since Annette is pretty smart, I think she can probably tell us about that.
I can most certainly tell you about that, Sheila. So on an individual account, those accounts are going to be insured up to $250,000, and you would title that in an individual's name. For example, my name, Annette Moore. And again, there's no named beneficiaries on that. If I had a joint account where you have multiple owners, you would title that again in a person's individual name, like Annette Moore and John Moore, my husband. Again, we have no named beneficiaries. The coverage on that is $250,000 per joint owner. With the trust accounts, there is two ways in which to establish that. You can have a formal trust that's been drawn up by an attorney, such as the Moore Living Trust. That account is going to be insured $250,000 for each owner to each beneficiary, the pairing up of that. Those type of discussions will go into a little bit more in depth, I think, in our August.
Mm-hmm. August 15th. Be there, be square.
Yes, because those questions we get a lot of, and we're dedicating an entire presentation for that. You can also have a revocable trust where it's in my name, or even, let's say, my husband's name as well. But if we start naming beneficiaries, let's say our 3 children, that's going to be called a informal revocable trust, and we commonly refer to that as a payable on death, or a POD. It's also referred to at times as an in trust for, ITF. An irrevocable trust is also generally drawn up by a attorney. The difference between revocable and irrevocable is the revocable you can change. So if you want to change your beneficiaries, you could. On an irrevocable, you are not able to. It's pretty much set in stone. You see a lot of grandparents maybe establishing that for their grandchildren to make sure.
I really haven't seen that many of them, though, or had too many questions regarding those.
No, most people are not.
Common.
No, they're not.
Yeah.
Most people are not wanting to set it in stone.
Mm-hmm.
But if you do have an irrevocable and a revocable, you would be insured for both funds in those accounts. So each one of those account types have separate insurance coverage, separate and apart from the other. The retirement accounts are, again, the Roth and the IRA, and then we have the business accounts such as the corporations, partnerships, unincorporated associations.
What about a DBA?
Now, a DBA is a little different.
Okay.
DBAs are doing business as, because those types of accounts do not have a unique identification number separate from the individual.
Mm-hmm.
And a DBA would be like Sheila's housekeeping service,
Yes.
maybe your lawn care service.
Were you looking at my tax return? No.
But if you have a DBA, the funds in those accounts are going to be added to your individual or single ownership account
Mm-hmm.
and aggregated together and insured to $250,000. So you can see you can have multiple accounts, an individual, a joint, a revocable trust, even an irrevocable. Maybe if you have a business account, a corporation at the credit unions,
Mm-hmm.
you can have more than $250,000 and have it fully insured
Awesome.
if it's properly structured.
Awesome. I think it's now time for a poll question. We can have the next slide, please.
All right, we have a poll. This is the first one.
First poll question. And that is, the question is, naming a beneficiary on an IRA account increases the account's insurance coverage. Does naming a beneficiary on an IRA account increase that insurance coverage? We'll give you a couple seconds. True or false?
And Sheila, we need to remind our audience to make your selection on the screen by selecting true or false on one of those radio buttons, and don't email your answer in. Okay?
Okay,
All
sounds
right.
good.
So are you ready?
I'm ready.
All right, here we go. See what it says.
And the answer is
Can you see it?
okay. So actually the correct response is false, which 73.3% of the audience.
Great.
Yeah, so we got a bunch of smart people here.
Yeah.
You know, if you got an answer wrong, I'm sure you hit the wrong button, you know. But, so, anyways, and Leilani's going to give us a little update on IRAs.
Sure.
Both traditional and Roth.
Absolutely. We just want to let everybody know with traditional and Roth IRAs, those type of accounts are insured separately from your individual accounts, separately from your joint accounts, separately from your irrevocable or revocable trust accounts. If, in fact, your credit union did fail, what NCUA would do would take your traditional and your Roth IRA, if you had both, we would add those together, and it would be capped up to the $250,000 limit.
Yeah, okay. You know, that poll question talked about a beneficiary, and I think now would be a good time to talk about, speaking of beneficiaries, that if you have an individual account, and once you add a beneficiary to that account, you change the type of the account. That account then becomes a revocable trust or a payable on death account once you add a beneficiary. And a qualified beneficiary is a living person, although our guidance believes says natural person, but it is a living person, a natural living person, or a 501c3 qualified charity under the IRS rules. So those are the only qualified beneficiaries. You can't name a pet or your hosta plant or anything of that nature. So those are all qualified beneficiaries. Yeah.
Now, Sheila, you can name a beneficiary on an IRA, and I guess you can name one on a business account or even a government account if for some reason they did that. But it's not going to help.
No, it doesn't provide you any additional insurance coverage.
So when you start naming beneficiaries on a single ownership or a joint ownership,
changes the type
to a revocable trust.
But if you do it to an IRA or a business, doesn't do you any good.
Okay.
Okay, very good. So moving on, you know, we talked about joint accounts, and a lot of times we get questions regarding coverage, insurance coverage on multiple joint accounts. And I believe Leilani will be talking to us about that.
So what I'm going to do is give you kind of an example, Sheila.
Can I have another slide, please? Thank you.
Just so everybody can see what we're talking about. So there we go. So Sheila, say for instance, you and I have an account in the credit union, and that account has a total of $200,000 in it. And Melissa, say for instance, you and I have an account at the same credit union for a total of $100,000. What NCUA would assume is that we have equal portion, like equal withdrawal rights in this account. So we would assume that my portion of, Sheila, yours and my money is $100,000.
Okay. What if I take out 150?
Okay.
Doesn't matter.
Yeah,
okay.
we're not there yet. Okay. And the portion that I have with Melissa would be $50,000. $50,000. So we would add my portion of Sheila's account with me, myself, and the portion, my portion with you, that would be $150,000. So I have not exceeded my limit of $250,000 of my account. So all of my money for the $150,000 would be insured.
I like it.
Sheila's money and Melissa's money?
Yeah, their money is insured too. Sheila's $100,000 would still be safe. She hasn't reached that $250,000 limit, and Melissa's $50,000 would continue to be safe and insured.
In other words, each of the three of us gets insurance to $250,000.
You are correct. Yes.
Okay, so what if we change the facts up a bit?
Okay.
And change the slide up a bit?
That's not the slide. Thank you. So here goes. This is the second example. Sheila, we put more money in the account.
Because we're loaded.
We are.
Yeah.
And the account has $500,000 in it. Melissa, we haven't put any money in our account, so we have that same $100,000. Again, equal portion. So 50% of the money that I have with Sheila, my portion is $250,000. Okay. Again, my equal portion with Melissa is the $50,000. So if I added my portion, $250,000, the account with Melissa, $50,000, I have a total of $300,000 in that credit union. I have exceeded my cap of $250,000 by $50,000. So I have $50,000 that is uninsured. However, the money that Sheila, you have, the $250,000 is insured. You are good.
Okay.
Melissa, the money you have, the $50,000, still insured. I'm the one that would be exposed by $50,000.
If the credit union were to fail.
If the credit union were to fail.
And that's also assuming, is it not, that, Sheila, you have no other joint accounts at that credit union, nor Melissa?
Correct.
Because I assume if you had another joint account, let's say with your husband,
right,
any money in that would be uninsured because you're already at your $250,000 limit.
Okay.
Right?
Right, but I don't.
Okay. That's good.
Okay. I think now we're ready for another poll question, please. And this poll question is...
As soon as it comes up, here it comes.
As soon as it comes up. But I'll start talking about it.
There it is.
How long does share insurance coverage continue after the death of an owner? And our options are, it ceases immediately, 6 months, 12 months, or 24 months. So please submit your answers.
So now, Sheila, don't forget to remind your audience.
My audience.
Your audience.
Yes.
That we need some questions. We've gotten a few.
A few.
But
okay.
I know that there are a lot of questions about share insurance.
There's got to be questions.
There's plenty of questions.
Yeah.
Don't wait until the end, folks.
Exactly.
All right.
Thank you.
You ready for the answer?
I'm ready.
Okay, let's go. Here we go. And it's going to come up very slowly. There it is. I see it.
I don't see it.
Okay, here it comes.
Ooh.
There it is.
Ooh. 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 Well, 43.4% of you have answered the question correctly. I see a lot of it thinks it ceases immediately, and actually there is insurance coverage that does cease immediately upon a death or a passing, and that would be if a beneficiary passes away, the insurance coverage. But actually the correct response is 6 months, which Melissa is going to talk about, but I think Annette has something to say.
No, I was saying that is correct. When the beneficiary passes, owners need to go and talk to their credit unions and make sure that their funds are restructured immediately. If you have enough beneficiaries, you may be fine, but if you have just one beneficiary, your funds may not be insured. So you would want to go in and talk to your credit union representative.
Very good. But if it is an account owner, as Sheila said, we do offer an extension, or the insurance does continue for 6 months as if the owner of the account had not died. So it is important, though, to look at the accounts within that 6-month period and see if at the end of 6 months the insurance coverage is going to drop. So, for example, if Annette and I had a joint account and we had $500,000 together in that account, right now as a joint account, we're fully insured, $250,000 for me, $250,000 for Annette. I think we do too.
Yeah.
Thank you, Sheila. So if we could advance to the next slide. A little bit of a lag on here, but there we go, 6-month grace period. As we'll get to also, it does apply even when it is a term account. And I believe we have another slide after this that gives the example. If we could just go ahead and, there we go.
Next slide.
Yes, the next slide, if you could, please. Again, just talking about what happens with say a joint account where Annette and I have $500,000 in the account, and as joint owners of the account, if that's our only account in the institution, we're fully insured. But then if Annette unfortunately passes away, then after 6 months, half of the money that I have in there is now exposed because it's no longer a joint account, it's a single owner account. So again, as I was saying, it's important to look at the accounts, and this rule applies even to term share accounts, CDs in other words. If there is more than 6 months remaining to maturity on that CD, the 6-month grace period still applies. So we do encourage people when they are faced with that situation to talk to their credit union if they're going to have exposure as a result of a death of a joint owner on an account, and see if they can restructure that. We have no authority to ask the credit union to waive any early withdrawal penalties, but we would certainly hope that the credit union would be understanding in the circumstances and consider doing that. But the rule, again, is 6-month grace period after the death of an account owner, no grace period, no extension of insurance coverage if a beneficiary on an account dies.
Very good. You took away my summary statement, but that's okay. But again, to reiterate, death of an owner, you have 6 months to restructure. Death of a beneficiary, you better get there the next day. So, to continue insurance coverage anyways. So just to elaborate a little bit more, I know we touched briefly on the business account when you were talking about how to strategize, but could you talk a little more about that, Annette?
For a business account to be insured, again, it can be a corporation, a partnership, a limited liability company. It would have to have its own separate tax ID number. Mm-hmm. Again, the DBAs, the doing business as, would not have that, so they're not going to have separate insurance coverage. So they have to have their separate TIN number. They would also have to be independent activity. And for an example, let's say you have a corporation. They have an operating account as well as a payroll account. 2 separate accounts at the credit union. But because they're still under the same ownership of the corporation, the accounts would be added together and only insured to $250. If they were separate type of independent activities for those accounts, they could have $250 separately. But in most cases, they're going to be added together because they're all owned by that same separate or that same corporation or business entity.
So, Annette, very often question I get from credit unions is there's 3 people who are authorized to sign on the business account. Does that increase the insurance coverage because there's 3 people who can sign for this corporation?
No, it's not like a joint account with multiple owners, which each get $250. A business account is merely $250,000. So you could have one signer or you could have multiple signers. It's not going to increase the coverage.
Very good. So I think we're up for another poll question, please.
All right, we're going to go to a poll question. And when you ask the poll question, I have a good question that maybe you might want to entertain. The team may want to entertain.
Okay. After the poll question?
Well, while the poll question is commencing.
Okay.
How's that?
So the poll question is, which of the following account types require all the owners of the account to be members of the credit union to have share insurance coverage? This is a joint account or revocable trust accounts, meaning something with a beneficiary. So please give us your answer.
So now here's a great question that came from your audience.
Okay.
So you guys look so excited that you want to answer a question. This is a good one.
Okay.
It says, credit union says, so if we can't locate the member account agreement signature cards, are the funds in the account still covered?
They can't locate.
Okay,
Where is it?
so, well, I don't have all of that. They just said if they can't locate, for whatever reason,
Okay.
they can't locate the member account agreement or signature cards, would the person still have their funds insured? And the answer, of course, is?
Well, would you like me to jump in?
Please.
Frank, you want to come over?
Yeah,
and
sure.
Frank is from our Office of General Counsel, and when we have questions we need assistance with, we
Send them to Frank.
send them to Frank.
So the answer is what you have there is a proof problem. If you have a credit union member that has an account, they are entitled to share insurance coverage. What you mentioned is not whether they actually are members or are not members, it's whether or not you can prove it. So if you can't find the materials, it would really be helpful to try to find some other methodology for proving it. So perhaps the member could bring in statements or other documentation to show it. So it's tricky. You want to obviously have all of your materials, but if you don't have the key things, you might have to turn to secondary sources to prove that they are members. No, though, if you can prove it, then you might have a problem.
Interesting. That's a great question and great answer.
Thank you, Frank.
All right. That's why we keep Frank on.
That's why Frank is.
So,
keep on
yeah, we like Frank.
Absolutely.
So now let's go to the answer. Sheila, how's that?
Okay, let's get
All
to the
right.
answer.
Here we go. The answer's coming up. We have a delay, but here it is. You see it? There it is.
Okay. Well, 42.3% of you have given us the right response. But so the answer is revocable trust. All owners have to be members of a revocable trust in order to have the share insurance coverage. The rule for joint accounts, which is kind of surprising, and I was surprised too when I discovered this, is you can have a joint account and only one person has to be a member. A joint owner does not necessarily have to be a member. They have to have equal withdrawal rights and equal access to the funds. However, and that's just a plain joint account, no beneficiaries. And then, of course, the revocable trust, we have all owners must be members. And an irrevocable trust, which is the ones that are not all that common, that are dealt with attorneys draw up and stuff, it's either all owners of the trust or all beneficiaries of the trust must be members. So it's an or situation with the irrevocable trust. So I just thought I'd touch on the membership issues just because I believe that does come up. And I think next is a slide regarding our share insurance resources. And Leilani is going to talk a little bit about those.
Yes. NCUA provides some great resources on share insurance, and we invite our credit union community to go to our website, type in mycreditunion.gov. It lists several links that you can go to review, but the one we are really proud of is our share insurance estimator, which will, if you were able to go in and put in your information, it would spit out a report, well, maybe not spit out a report, but maybe provide you with a report that would tell you if your account was covered. Annette is going to give us a demo on how to use the share insurance estimator a little bit later. Also, as part of our resources, we have some great videos that a credit union could use. There's about 3 of them right now that are posted. It's called the Overview of Share Insurance, Review of Account Ownership Types, and we also have an instruction video on how to use the share insurance estimator, just in case you missed some of the steps that Annette's going to go through today. We also would say that the credit union staff could use the links that they can actually put the share insurance videos on their website by placing a link to our website, and they can be able to review the videos, use it for training, or also for their members to even look at while they're there at the credit union. So we invite you to do that. We also have brochures and booklets that we use. As one of our favorites is Your Insured booklet. We love that booklet. I mean, I use it often, at least once or twice a week.
The most recent iteration of the booklet is a January 2018 date, just to know you had the most current one.
It's very current, very current. Another brochure that we use is called How Your Accounts Are Fairly Insured. And the next one is Your Insurance Coverage Overview. We want to let you know that all these publications are in Spanish, so if you needed that, they're available in Spanish. If the credit union wanted to order some of these publications, you can call our publication office. The number for the publication office is 703-518-6340. Please use these resources. We put them out there for your use. They can be very helpful. And sometimes if members come in and they just kind of want to review it, it's helpful. You can talk through them, and you can also use them for training. So please feel free to use these resources.
And I think next, for excitement, is Annette's going to do a demo on that share insurance estimator.
I am. I've shared my screen, so let me make sure it just pops up here before we start in. So again, all you need to type in is mycreditunion.gov. There is a number of ways to go to the share insurance estimator as well as the other materials. If you go under financial tools and resources up here on the top, you'll come down and it's the third one from the bottom, share insurance estimator. That is one way. You can also find it here on our home page. If you click on learn more, which is I'm going to do, if you just want to go to share insurance estimator, you could click on this button here at the bottom, but I'm going to click on Learn More because I'd like to show you our videos as well as the brochures. So here is the page that pops up. You'll see here as I scroll down, here's the share insurance estimator. Below that is the videos. And you'll see that there's the 3 videos right there. And then below that we have our share insurance publications. Again, those are in Spanish. If you click on them, you can even print them yourselves. So let me go back up here to the top and click on the Share Insurance Estimator, and let's go there. That's where I would suggest member service reps and frontline staff at the credit union go to that resource. If you have a member in front of you with their questions on share insurance, that site is also able to be used by members themselves. So if I click on the Share Insurance Estimator, that takes me to our main site. Before I get into the estimator, I want to bring out some other points here. You'll see that we have Share Insurance Frequently Asked Questions here at the top. There's a number of questions there. It's extremely thorough. If you need to contact us, if you click on that, you will see that there's an 800 number and the option 1. So let me go back to home. I also want to bring out that at the bottom there, we have a glossary of terms. So if there's a term that you're not aware of, you can click on that glossary, as well as when you're in the Share Insurance Estimator, you can click on terms and they'll pop up. And this last button on the right here is the Espanol. That will change it into Spanish version. So I'm going to click on the green button here, and let's go to the actual Share Insurance Estimator. Now this tool has been set up with some nifty help resources. This first one, what's this? You'll see that that's in a number of places here. If you click on that, it'll expand and it'll give you additional information on those different areas that it's next to. You'll also see this X, the red X.
Is that like a ah?
It is,
Okay.
Sheila.
All right.
If you get that, it will not let you proceed. You have to resolve that issue before you can proceed.
Okay.
So what I'm going to do is kind of set up a little scenario here. Melissa, you want to give me the name of a credit union? A simple one, maybe?
Sure. How about RIA?
RIA. All right. And I'm going to set up that we have a personal account. And under the personal accounts, you'll see we have the single with no beneficiaries, joint with no beneficiaries. If you have beneficiaries, the payable on death, you'd select the POD or ITF in trust for. If you have a formal trust, revocable trust, like a net more living trust, you'd select the fourth item down. If you have an IRA or if you have other. We're going to set it up. We have a single ownership, no beneficiaries. My owner's name, let me scroll up a little bit. I'm going to say is Melissa. You'll see to the right here, it says, is the owner living? Melissa, are you living?
Pretty sure I still have a pulse, yeah.
Oh, okay. And are you a member of the credit union?
Since the 1970s, yes.
All right, so I get to click yes here. The nickname, I'm just going to say is, let's say, your savings account.
Savings account.
And how much money you got in that?
Well, I have a hidden stash in spite of our earlier analysis. I got $200,000 in that account.
Okay, $200,000. All right. So I'm going to add that to my report. So when you add it, it populates, and you want to hit this calculate coverage, and, oh, you're insured.
I am. Well, that's not my only account there, and
oh. Well, here, just a minute. I can add another account for you.
But wait, there's more.
So if I add another account.
That's just my savings account. I have a checking account there, too, or share draft account.
All right. It's another personal account.
It is.
And single ownership, I assume?
It is.
Okay.
It's all about me.
Okay. And I'm going to, and I know you already answered this, you're living in a member. Your nickname is you said this is checking?
My checking account.
All right.
And I keep a cool $100,000 in this one.
A cool $100,000? So I'm going to add that to the report now. So you have $300,000 at the institution. So the result should be that you're uninsured for a portion.
That's what I would think.
Wait a minute. Something happened here? What did I do? Oh, my goodness.
What did you do?
I misspelled Melissa's name on her checking account.
Get that right.
So it's recognizing it as a different.
So, yes. So
It's important to have the exact same name in the owners, in other words.
If I don't have the correct name in there, it recognizes that it's two different people, it looks like.
Exactly.
That's a nifty tool. So now when I calculate it, it does show like it should. 250,000 is insured and 50,000 is not. Okay. You have any more money?
I've got lots of money.
All right. Well, let me add it.
Want to get into my joint accounts now?
Yeah. Let's do a joint account. Personal account again. The ownership type is, again, no beneficiaries, just joint, you and someone else. So I'm going to make sure I spell your name right this time. Oh, it auto-populates, so I can actually select that.
There we go.
And you're a member. Who's your other owner, Melissa?
Terry, Terry.
Okay. Is that your husband?
That is.
Okay. Is he a member? He is not.
Yes, he is.
No, he's not.
No, he's not.
He's not. Okay. So if I click no here, I cannot proceed because I get this
Big old X.
All right.
Red X.
So I'm going to click on that because it's going to tell me something. You did not answer the question, is the owner living and a member of the credit union?
You did.
Respond to the question using, okay. Let me click on this.
But remember, on a joint account, I think we said that the joint owner doesn't have to be a member.
That is correct.
That is correct.
So this should be popping up. I'm not sure why that's not working. Here we go. If we look at yours, you'll see here, please note if the account is a joint, no beneficiary, additional owners are not required to be members of the credit union for the funds to be insured by NCUA. Therefore, answer this question yes for all owners of an ownership type of joint, no beneficiaries. So that tells us that we need to answer yes, even if it's a joint account and they're not a member.
But he does need to be alive.
But he does need to be alive, yes. Your nickname on this account?
Oh, this is a CD.
Okay, I'm going to put a certificate. All right, the account balance?
Oh, I think we got 500,000 in this one.
500,000? Okay.
I'm rolling in it.
All right, I'm going to calculate coverage, and you are insured for as you each have 250.
All right. 500,000 for the two of us, right?
Yes.
It's a joint account.
Yes.
But that's not my only joint account.
Oh, all right. Man alive, you got money. All right, another personal account.
Another personal.
Joint account. Okay. Are you the main
I am.
owner?
I'm an owner.
All right. Populate
my
you.
dog rolls in it too sometimes.
Okay, so who's your other owner on your?
Dorothy.
Dorothy.
My mother.
Okay, I thought maybe Dorothy from Oz. Kansas. Is she a member and is she living?
Yes, she is to both.
All right. And nickname on this?
Oh, this is another CD.
Another certificate?
Certificate 2.
All right, I'll put certificate number 2. And the balance you have in there?
200,000.
200,000. So I'm wondering if our audience knows what's the result going to be. Is this money going to be all insured or not? Sheila, you know the answer?
Let's take a poll question. A panel poll question.
All right, a panel poll. What do you think, Leilani?
Oh, no.
No?
Melissa? I say no. Exposed. I believe she's exposed.
Yeah.
Yep.
Melissa, are you exposed?
I am.
And how much?
Half of that account with my mother is uninsured. Because I maxed out my insurance coverage with my
Multiple joint accounts.
my husband's account.
Correct.
It should be about 100,000.
Right. On the joint accounts.
So how do we correct that? Is there a way in which we can correct that?
There's many ways we could correct that. Would you like to be a joint owner on my account?
I could be a joint owner,
You could
or
be a beneficiary.
We could put it in another credit union.
I can diversify
Yeah.
to another institution.
How about naming some beneficiaries?
Exactly. Then it's not a joint account anymore or a single owner account. It's a payable on death account.
That's true.
It
So,
becomes a trust.
well, you know what? Is the money that's with your mother in her joint account, is that your money or is that really her money?
Well, she thinks it's her money.
She lives off of it, or
yeah,
okay.
it's her money.
Okay, well, and are you're on there to help her sign?
Right.
Okay. Well, what we can look at doing here is we can change it from joint with no beneficiaries to a payable on death. And by doing that, we can name a beneficiary.
You can make my husband the beneficiary, Terry.
Okay. And then let's save our edits and see what happens. We got an X. Let's see what we're missing here. Oh, is Terry a person or a charitable nonprofit organization?
Well, sometimes I think he's a charity, but I think he's really a person.
All right, he's a person. Save the edits. Oh my goodness, we got another one.
Oh no.
Is Terry living, a living beneficiary?
Yes, he is.
All right. Now we should be able, I think, save our edits. So let's go and see what happens. Now, if you look at this last column here, we have no uninsured funds. So by naming a beneficiary, you can obtain additional insurance coverage.
Exactly.
Because each of these accounts are separately insured from each other.
And we can use this calculator to do an analysis to see what are the options for getting maximum insurance coverage in a credit union. And it's something that credit unions and their members can use, right?
Yes, it is. It is a great tool.
Well, thanks a lot, Annette, for your razzle-dazzle on the Share Insurance Estimator.
You're welcome.
You know, that's great. Can we get the next slide up, please, Patty? Again, before we open this up for any questions, here's a friendly reminder to please, not that I'm begging, to sign up for our Cure 2 webinar. Mark your calendars, August 15th. We're giving you the Cure in Depth, 2 p.m., same time, same channel.
And Sheila, what's CURE?
Credit Union Resources and Expansion.
Our office name, huh?
Our office name.
That's pretty clever.
That's very clever. Whoever thought of that should get an award. And also, if we can, you got the contact page. If you have any Share Insurance questions, please feel free to contact our office with questions or comments. Our phone is 1-800-755-1030. Hit option 1. Or if you prefer to communicate via email, our email address is dcamail@ncua.gov. That's dog, cat, apple, mail @ncua.gov. Or as Annette says,
Division of Consumer Access.
That's us. But so, Catherine, what do we got for questions?
You have a ton of questions. Actually, Annette is now popular because
of course
we have quite a few people that love that demonstration. So here's our full office contact page as well. And I just want to remind everyone at the bottom of your console all the way to the right that it's not the green one, it's the aqua. It looks like a little tablet or something. It's teal, not aqua, so it's teal. Yeah. That's our survey. If you click on that, and while we're doing our Q&A, if you can do our survey, we'd really appreciate it. And right next to it in the green, you can register for part 2 because we're really going to get into some real heavy things in part 2. So now, here we go with the Q&A. And we're going to get to as many of these as we can. But know for a fact, if we don't get you before the webinar concludes, we will have answers for you thereafter. So I think I'd like to put Annette on the hot seat to get question number 1. How do you feel about that, Annette?
Okay, I'll do my best.
Okay.
I got good backup.
Indeed you do. You have a question here. So the credit union says, if you are an owner and a beneficiary in separate accounts, will that individual be covered to $500,000? So they said you're an owner and a beneficiary in separate accounts.
The owners are the individuals that are provided the insurance coverage. So if I am an owner of an account and it's a single ownership, I have $250,000. If I'm named as a beneficiary, let's say on my mother's account, my mother gets insurance coverage as a revocable payable on death trust account, but I am not insured. My mother is who's insured. The owner beneficiary is the person insured. So both accounts would be insured, but I'm not provided coverage as being a beneficiary, only as an owner. My mother, as the owner with me named as beneficiary, would be provided the coverage. Does that make sense?
Oh, yeah. It really does. So if I get another follow-up question, then we'll know for a fact. So now, Annette, you touched on something in your demonstration. So I think the credit union wants to have clarification as to why Terry had to be answered as yes, is whether he is living and a member.
For a revocable trust account, the owners have to be members of the credit union. So if they're not members, their portion of their funds are not going to be insured. If you're at a bank, FDI insures all of the accounts. At a credit union, because you have to be a member of the credit union, that is like the first hurdle you need to overcome before knowing if your accounts are insured. Because NCUA only insures member accounts at the credit union. And the only exception is for that joint account.
Well, I was wondering if the questioner was asking because when we originally, because Terry was not a member and we got the big red X.
Yes.
And then when you found the language that says, okay, go ahead and answer yes anyways, whether or not it's, the system hiccup. You know, like basically we were, I don't want to say gaming the share insurance estimator, but.
Well, the beneficiary doesn't need to be
Terry
a member.
Was a joint owner.
When it was a joint account, before we changed it over to the payable on death, we still had to answer that question, yes, and it's partly because it's a two-part question. The question is he a member and living? And if you answer that no, it doesn't know which part of that you're answering no. You're answering that the whole thing is not true. So to make the calculator work correctly, you have to answer that question yes, but understand that a joint owner does not actually have to be a member. It is just a quirk of the way the calculator is set up that they ask a two-part question, and you have to answer really both parts are yes. Even if the person isn't a member, it's okay, but that's the only way to move forward in the calculator.
Right.
Okay. You guys are really heavy. How about that we get our host to answer a question? Sheila?
Why, certainly, Catherine.
Okay.
Talk it to me.
I will.
Okay.
I'm going to let you have it. So here's the question. So we had some confusion on the 6-month rule. So it says, does the 6-month apply to an individual account if there are no joint owners or beneficiaries?
Yes.
Any more?
Huh? Well, what you're saying is an individual in a credit union passed away, and there's no joint owners and there's no beneficiaries on that account. Would that account still be insured in the event that the credit union failed, like after the owner passed away? That's basically what they're asking.
Oh, okay.
Correct?
Okay.
So, and
Repeat the question.
how about I repeat the question?
well, okay.
Does the 6-month rule apply on an individual account if there are no joint owners or beneficiaries? So Frank wants to come. Frank, do you want to come over?
That.
So the real question isn't so much whether it applies or not. The real question is, does it help or not? So the reason we give the 6-month rule, the 6-month grace period is, if there are, say, 2 joint account holders and they have $500,000 worth of coverage, when one person dies, there's only one person remaining and they get the money. So then now they have $500,000, but the account has changed from a joint account to an individual account. With $500,000 in an individual account, then you've got uninsured money. So we give that 6-month grace period so the survivor has time to restructure the accounts or take the money out of the credit union so they don't have uninsured funds. It works similarly when there are beneficiaries. For example, if you had a payable and death account where husband and wife had POD to a child and they put $500,000 in, if one of the parents died, then the surviving parent would have $500,000 and only one beneficiary, so there'd be $250 uninsured. So in each of those instances where you have multiple owners or you have a beneficiary, the reason the 6-month grace period is important is because in those circumstances, the share insurance changes and there's uninsured money. If you just have an individual account with $250,000 in it, when you die, no one's coverage changes. There's no beneficiary that gets calculated into this. There's no joint account holder who now has over funds. So while technically the 6-month grace period would apply, it doesn't help protect any coverage because the coverage stays exactly the same. You've got a member who had $250, that account would sort of morph into a decedent's account for $250, same coverage. So it's more a question of would it help in that scenario.
Okay, don't go anywhere, Frank, because this is a follow-up question.
Okay.
And we're running out of time. So we're going to answer all of your questions when we post the webinar, but this is a follow-up. So now the subject of probate comes in, and we may want to defer this to part 2, but I'm going to ask it as a teaser. The credit union said, what if the will of an owner who passes is in probate for longer than 6 months? Can I get an extension to the 6-month period?
The short answer is no, there's no extensions. The more in-depth answer is probate's very complicated, and that does complicate it, but it doesn't change our share insurance. But the long and short of it is we have a 6-month grace period, and that's it.
Wonderful. I hate to say it, everybody, but you know what? We are fresh out of time. Leilani looks relieved. She's like, whoo, she was going to ask me a question, and I was.
You were next up.
So thank you so much to our panel. We had a wonderful panel. And guess what? Don't forget, use the the green widget.
Oh.
The green widget, you can register for part 2. And that's where we're going to really answer a lot of heavy questions. You asked a lot of us these questions here, but we're not going to answer them right now, but we will answer them in part 2. So please come back August the 15th. Register now. Don't wait. And don't forget, look at the teal little icon. That is the survey. We really want your opinion on this webinar and recommendations for future ones. Thank you again to our panel, Melissa Fowler, Sheila Snock, Leilani Stamper, and Annette Moore. And our behind-the-scenes guy, Franz Ayento, which we could not do anything without, and Patty Hunt. And Kenzie has been tweeting. I didn't give Kenzie her props. We were on Twitter live, and we'll do the same next time. This is Catherine Baxter. I'm signing off for today. Have a wonderful afternoon and a great week.
And thanks.